Good morning, everyone. I hope you're all enjoying a couple of good days in Cape Town, and I hope you're all having a good one-to-one mining conference. My name is Heinz Pley. I'm the head of mining and metals for Oliver Wyman, Marsh's sister division. We're a management consultancy with 5,000 consultants around the world and cover many different topics. We have an illustrious panel here today with me, René Trenot from SocGen, Global Head of Mining and Metals there, Thabiso Sekano from the IDC here in South Africa, the Head of Mining and Metals, Morten Lian, Director of Investment Banking and Clarksons Platou, and Nick Farr-Jones, Portfolio Manager at Taurus Fund. So the topic of our discussion is mining finance and funders. It's about developing economic discoveries and funding those developments for the next generation of mines in Africa. That's really our topic. I just want to make a few introductory remarks before really throwing questions to the panel, and then maybe we have a little bit of time in the end to also involve the audience and have you guys, throw questions at our esteemed panelists. So if we look at the world we're living in, it's really full of complexities and risks, notwithstanding economic headwinds that we're facing due to economic slowdown in major markets like China, mainly driven by their COVID lockdown, and the US, mainly driven by also the Fed tightening, as well as massive energy supply risks that are really hanging over Europe. The prices of many mined commodities are historically high. So it's a pretty interesting kind of disconnect between where the global economy is heading and where commodity markets are. This is really due to the supply side. It's due to rapidly growing energy transition requirements that create obviously new demand, lack of exploration success for many decades, really, and also slow new mine development over the last few years, driven partly by austerity of mining companies after their spending in the China boom 15 years ago. Supply chain dislocations driven by COVID, economic sanctions against Russia and Belarus, and also coal supply shrinking much faster than coal demand. It's much easier to cut down permitting and financing to coal mines than to get major coal plants to shut down on the demand side. So very interesting context. The need for new mine development does great in order to really bring supply back in line with demand. And Africa offers vast quantities of unexplored and unexploited mineral resources, which many of the companies represented here at the one-to-one in Cape Town are exploring and looking to develop. So that really brings us to the point of what does it take to develop a mine in Africa. Many stars have to align to develop a new mine. You have to have your technical work, your feasibility studies and all this under control, of course. You have to have the formal permits. You need to have your social license to operate in order. You need to have the support of local communities along your chain. And you typically need external funding, both equity and debt. So in this panel, we want to explore the financing question. How available is equity and debt finance today for promising mine developments in Africa? And what are the key success factors for tapping into this available capital? So if I may throw the first question to the panelists, and I would love for maybe more than one of you to comment on each of these questions. Hopefully at least one of you will have a good answer. Firstly, when we look at the technological developments, decarbonisation, electrification, sequestration, they all drive investments into new minerals and into energy markets. How vital are African assets really to meet global supply gap for critical minerals like cobalt, nickel, lithium, what have you?
Is it on? Okay, yeah. No, I think that to enable the energy transition, we will need low-cost battery metals. And African assets have high grade and potentially low cost. So from a credit perspective, that enables credit investors. But there are some other things that makes them less attractive. But of course, to enable the green transition, we will need low-cost energy metals, and Africa will be and must be a vital part of that going forward, I believe.
Thank you. Any other? Nick, please.
Sorry, from our perspective, so Taurus Funds Management, we're head officed in Sydney, but we're in Perth, Melbourne, and we've recently opened a London office. Under our mandate, we raise funds from US institutions at this stage, predominantly US institutions. So our mandate is precious metals, base metals, metallurgical coal. We don't do thermal coal, but it can be predominantly metallurgical coal, and industrial minerals, so typically mineral sands and the fertilizer products. We in Africa, we're involved in one copper project in the DRC, probably won't return to there, and that was a disappointing story for us. It's really only our only write-off that we've had, but we've done probably $1.5 billion of funding of gold projects in West Africa. So we're fairly comfortable in most of the Francophone countries. Like Lenaig, I had 14 years with Société Générale, 4 in Paris, and then 10 running the mining finance team. So we're very comfortable in Francophone West Africa and Anglophone. But we really have focused on what we know, what we've had experience. Our team is about 20 investment professionals, half have technical experiences and backgrounds, and probably half of us have banking backgrounds. So we're very comfortable looking at those gold projects. Of course, as we go to the electrification of everything and the new world of batteries, graphite, lithium, rare earths are going to be very important. We, again, try to stick to what we know. We're just starting to look at lithium. We believe the market's grown significantly, that it's not an opaque market anymore, that there's a lot of experience out there about what's worked and what hasn't. But we probably won't do rare earths, we probably won't do graphite, but there's no doubt that there's a lot of organisations, including government, quasi-government, export agencies. And where I come from, Australia, you get a lot of, as I said, quasi-government organisations who are prepared to step up and support projects, particularly in Africa. So I think there's a lot of good funding that will come from those organisations, very keen to support the emergence of these new commodities.
Very good, thank you. Tabiso, yeah?
Okay, yes. Maybe just to sketch a scene quickly. I'm with the IDC. It's a development finance institution. We've been in existence for over 75 years. I head up the mining department. We've invested over 32 billion rands, total exposure in mining, mostly in South Africa. We are open for business in the continent. Of course, you know, the flavor of the day, energy minerals, we're short of those in South Africa. And we're looking to get as much investments as possible in the African continent. So that's our key focus area. We are way into decarbonisation. Some of you who might have been at our function yesterday may have heard my boss really mentioning the strategic nature of energy minerals, decarbonisation, the green economy, and all of that. So that's what we'll be focusing on. We're looking at a couple of projects in the DRC. We've got actually an investment in the DRC with Alpha Min, and we're looking at more also to look at minerals such as graphite and several others that we may not have in South Africa. Thank you.
Can I just ask a quick question? Sorry, Lenaig. What is your typical ticket size that you guys will write?
Look, we invest from $1 million rands up to about 1.5, depending on credit risks limits that are put on us. But we're really open to do anything.
Yeah, maybe I'll just complement all this from the SocGen and commercial bank standpoint. So I'm heading the global team called Mining Metals and Industries, actually, as of recently. And the idea was for us really to follow the trends, the energy transition trend, and make sure that with our background and understanding of the metals and mining, we would follow actually as well, you know, the industry side. So the battery manufacturing, the solar panel manufacturing, because obviously you need a lot of metals for all the energy transition developments, really. So we've always been historically very active in Africa, as Nick said. Actually, we have as well a retail banking presence in West Africa. So probably been a bit more active on that side of the continent, but you know, we've done financing in South Africa, in East Africa as well, and we're really ready to continue to support the mining business. The bank is extremely focused on this energy transition topics, like you know, most institutions obviously these days. And I think internally the story and the role played by metal in the energy transition globally is really well understood, well acknowledged, which means that the financing of the mine itself as well is considered a strategic aspect because it fits the energy transition mandate. So obviously we have appetite for the more traditional base metal, precious metals, but we're also active in the lithium, cobalt, looking at rare earths. We've done a deal in rare earths. So pretty open as well in terms of underlying commodities.
No, thank you all for that. It's really interesting. Up until a few years ago, commodities like maybe lithium, they were just too small to matter, right? Major mining companies wouldn't even look at it, etc. And it's abundantly clear now with such a determination to reverse climate change that there is so much demand coming up within the battery metals cluster, etc. And whether it's a bank or whether it's major mining companies, everybody's extremely focused on this. Having said that, it's very clear that for some of these metals that are required for the energy transition, there just will not be enough supply coming from anywhere in the world in order to meet all the projected demand. And there is a bit of a paradox potentially emerging. So that's something I wanted to touch on. It's one good and well to kind of, drum up demand and supply of these metals, but they just won't be coming along fast enough. So is the phasing out of fossil fuels, whether it's thermal coal, gas, oil, is that all going a little bit too fast, irrespective of really the ability to replace that energy supply by electrification and green energy and hydrogen and all these solutions that will surely come in the fullness of time? Maybe views from you guys. Please go ahead.
Well, I come from Australia, so we're a massive coal producer, metallurgical and thermal coal, and you find that the banks are dropping away in those, both even metallurgical coal. So there's tremendous opportunities for us as an alternative financier. And we've done quite a bit of metallurgical coal in Queensland, the Bowen Basin funding. So we've got a small side pocket to do some equity as well. So we're more than happy to use some of that equity in our second debt fund, which is a $1.3 billion fund. So we've done a lot of metallurgical coal, but again, coming from Australia, and we all know that countries are pushing towards net zero targets, and we all have different sort of ideas of when that could be achieved. But Heinz, just in reference to your comment, I think it's got to be a balanced approach. I definitely believe that it has to be a staged approach for some of these other, sort of energy sources that we're talking about. It's going to take some time, I believe, to have stable, reliable, affordable energy coming from those sources. And at the same time, I'm a strong believer that if they're still building and operating coal plants in Asia, where most of our coal goes to, and we want to target a decrease in emissions as we all do, well then it seems to me that you use the best coal that's available, the highest calorific value, the cleanest coal, and that comes from largely the Hunter Valley of New South Wales. And it really does annoy me. We're 10 days from an election in Australia, and a federal election, and it really does annoy me, some of these green and independent candidates that run around demanding on closing down our stable source of energy. Probably in Australia, 70% still comes from thermal coal plants, and criticise the export of thermal coal to Asian countries. And yet, do they want to burn Indonesian coal, 4,000 kilocal as opposed to 6,000 in the Hunter Valley, or bring in coal from India? And we all know what's going on in the issues in Europe at the moment, and the reliability of some of those European countries on producing sustainable, affordable energy. So I'm a big believer in until things are proven in the alternative energy space and generation space, that we should still be relying on the best clean coal in the world.
Thank you. Martin, you had a comment. Please.
Yeah. No, I just want to tap into the lithium aspect of it. Last year, we worked with Lithium Americas. We financed a $250 million convertible bond for them, as well as $100 million in a senior secured bond for an a cobalt mine in Idaho, by a company called Jevois Global. And we see that the lithium prices has gone from March 2020, they were around 7,000 for lithium carbonate, and today these guys are selling at 70,000. They still produced at the same cost. So you see that the demand is absolutely astonishing, and they can't deliver, and they're not even close to deliver what they actually need for our energy transition. And then we see that the OEMs, the car manufacturers, they don't want to invest in mines predominantly, but now they have to invest in refining and they have to secure their supply. So the market has totally changed. So we see that the financing and these mines have to be built to enable the energy transition. And as you tapped into coal. Last year during the COP26 in Glasgow, we did a $95 million senior secured bond, a Nordic bond for Pembroke Resources. That is a huge metallurgical development project in Australia, in coal. So who can finance coal in 2021, right?
Just on the lithium, your lithium client, how important was the strategic partner? I assume that they've got a very valuable strategic partner. Was that very important in the financing?
For Lithium Americas, that was a convertible bond. But yes, Lithium Americas has a strategic partner on their development in the Argentinian asset, but they also have another asset in Nevada, Thacker Pass. That is a non-strategic partner as of now. But these guys are not running around looking for offtakes because they know they can sell their product. Yeah. So the offtake partners now have to provide equity or something more to get the offtake, because why should they just sell it, right? So the market has totally changed within battery metals, and we see that for cobalt as well, and nickel.
Yeah, I think we see an increasing involvement actually of even the US government and the European government in helping companies, get access to the necessary minerals, and that's something that they haven't really done in recent times, right? To come involved. At the same time, also they are raising the bar in terms of disclosure on ESG, whether it's carbon, whether it's social impact, etc. So, and now we have a whole new, gambit with the sanctions against Russia and Belarus coming into play. So what are all these different factors adding to the complexities that the energy transition is in itself causing?
I mean, I think just quickly, particularly with what's going on in Europe, but as we drive towards these battery metals and strategic metals and rare earths, etc., and graphite and lithium, you're finding a lot of alliances that sometimes we don't know about between countries. Mineral-rich countries like where I come from, and mineral-poor countries, but processing technology very strong. I bumped into a lady in Sydney 2 weeks ago, and she was working in the German consul. And I didn't know, but we have an alliance, the Australian government and the German government, on strategic minerals. And we're working extremely closely, but that's something that most residents or citizens of Australia wouldn't know about. But that's happening right across the Western world. And because of what's happening in Europe at the moment with Russia and the Ukraine, I think you're going to see those alliances strengthen significantly.
I completely agree with that. Actually, we see more and more, and actually even as financiers, this is becoming an important topic, a clearer link between the downstream and the upstream. And I think the coordination between the upstream and the downstream, in particular for minerals like lithium, is actually very important. And I think when we finance a project, when we bank a project, a mining project, we want to understand actually, where the lithium is going, what's going to be the root of that lithium, and where will it end up. And the understanding of the whole value chain is something a bit new, actually, I think, for us.
Well, there are new requirements both from the EU and also from the SEC, right? To disclose really the entire value chain, and that's putting a lot of strain on certain players. Tabiso, if I may pose a question to you, IDC, a state-owned actor, but acting also for financial returns. When you look at your investments across the continent, what is driving your investment decisions? To what extent is it driven by financial return? To what extent by sort of resourcing for South African industrial enterprises, but to what extent maybe by political ties? It'd be great to hear your perspective on this.
Okay. So, obviously, our key criteria in evaluating any investment is economic merit. The project has to make sense. It has to stack up properly. Quite often, when we're looking at greenfields projects, we're looking at a feasibility study that has been completed that proves that the project can be sustainable. So those are our key issues that we look at. But also now, of late, we are also looking at the ESG component of the companies that we finance, so that we can all be socially responsible. So it's one of our key considerations. That's basically what we use to make investment decisions both in South Africa and across the continent.
Right. And are you looking also at, infrastructure assets? When I look at the South African context, power supply, transportation is becoming increasingly challenging. Is the IDC looking to help also privatization efforts, funding that, or is that something that's sort of not on your sort of radar screen?
Absolutely. In fact, one of my colleagues is sitting over there. She's in our infrastructure unit. She will be more than willing to listen to anybody who's got an infrastructure project anywhere in Africa. And if I may just weigh in slightly on this coal aspect, and apologies for that. I started my career at the IDC as a deal maker. So I'm trying to make a pitch here for everybody who is here to listen to us and come to us for business. So we're still open for coal in South Africa, as well as in the rest of the African continent. I mean, we sit in a very peculiar situation in South Africa where we're dependent on coal for energy. Most of our energy comes from coal. And those of you who are not from here, we've got blackouts and power cuts and all of those things that we are trying to address as a DFI ourselves as the IDC to ensure, in line with what the government calls the IRP 19, that over time we may decarbonize. But for the next 10 years, South Africa's energy depends on thermal coal. Thanks.
Fantastic. Thank you, Thabiso. Maybe if I can pose this question mainly to you, when we look at the commodity markets across the board, pretty much red hot. Equity markets have opened up for junior miners to raise finance. How are the commercial banks looking at this? Is the lending market becoming more open, more competitive, both between yourselves and also funds like Taurus that basically provide capital from non-banking sources?
Sure. No, and actually we always happy to work with a variety of different players. So in some context, it will be commercial banks, ECA, multilateral. In some other context, we worked with PE fund as well, with several tranche of capitals. I think the commercial debt has always been competitive and remain competitive. Obviously, so it's a good way to finance a project competitively. The competition, I think, is very high for projects that have that energy transition story. So it's important to have that right at the beginning. As I was saying, I mean, there's obviously the general sustainable nature of the project, but also the whole story. I go back to the value chain story. I think that's becoming very important. So I think SocGen, we're still pretty open across the board, beyond just the battery minerals. We continue to finance gold. This was our core business, remains our core business. But I think indeed for battery mineral project, competition is there from a lending standpoint, which means that it's good for project, it's good for company, because there's really liquidity available.
That's great to hear. Yeah.
I mean, from our perspective, there is, I think, great competition from the banks, and we, to be honest, will struggle to compete on a very good project. A good gold project, a good base metal project, just on cost, commercial costs. So we have to be flexible in the way we approach some financings. But talking about the equity opportunities, Heinz, I mean, there's I think companies at the moment, because one, the demand for commodities, and secondly, strong management, well-studied projects, they will always find equity. I mean, my old colleague Mike Anderson has recently taken over at Firefinch, and he's funding his projects out of equity. We were mandated by Tieto, but for whatever reason, which I probably won't go into, but they've gone out and decided they just want to go down the equity route, and so raised a significant chunk of equity to continue to build their project. And I think they're commissioning their project towards the end of this year. So there's plenty available, and you're finding that there's more and more alternative funders and more mechanisms like streams and royalty opportunities to basically put the capital stack together to develop a project. So plenty of funding out there for commodities, particularly, as Linnaeus said, battery minerals, which senior management are looking to go into and support. So I don't think there's any lack of both debt and equity.
Oh, that's great to hear. Now, clearly, ESG is the word, right? It doesn't just drive demand for the battery metals and, maybe drive down demand for coal eventually, etc., but also it drives different demands for the mining companies that are setting up, right? So how do sustainability criteria impact your financing decisions, and is that making it harder for juniors in certain African countries to raise the finance?
Yeah, it's becoming. I mean, as everybody knows, more and more a focus. And I would say for banks, beyond the what is now traditional ENS sustainability due diligence on a project, on a company, we also face the requirement at some point. We will face it to disclose as well, carbon impact of our portfolio. So the decision to onboard a project or a new client has also a lot of impact. Will have a lot of impact going forward on what we tell our investor and the market in terms of our carbon impact. So there's a lot of industry initiative to frame the measurement, to define a trajectory that makes sense for the industry and for the banks. But so that's a new factor actually that's start to come into our thinking process as well.
Right.
Is onboarding a specific project. What will be the impact of that specific project on portfolio emission?
Right. No, indeed. I mean, I had the privilege of shaping the sustainability strategy for one of the leading South African banks lately, and I was really interested to see how the bank was thinking about the just transition also, and it wasn't just about balancing their profitability from certain loans versus whether it was socially acceptable to fund these investments, but it was also in South Africa in particular a consideration of how maybe cutting back on coal supply would further the energy crisis that we already have and the impact that could have on the entire economy. So there was a balancing act to be had between advancing the energy transition, but at the same time keeping the lights on, quite literally. Yeah. So please, Martin.
Yeah, I just want to add there, what we see from our investors is a topic that was also discussed on the opening panel here at 1-to-1 yesterday, and that is we see that the ESG is a requirement, but it's also a binary. Either you check the box or you don't check the box. You don't achieve any premium above that, unfortunately. But what we have seen as well is we have seen a huge amount increase in focus amongst our investors to actually do the due diligence here properly. And you have to check the box. And if you check the box, they can invest. And I think that is the increasing focus on ESG is very positive for the whole mining sector, I believe.
Just quickly, I mean, 5 years ago when we were on a marketing trip to the US to see our LPs or investors, typically large US institutions, pension funds, endowments, 5 years ago we wouldn't get one question on ESG. And now those questions commence the discussion and the meeting. And it is a very important thing to focus on. I mean, it's easy to say your standards are the Equator Principles or the World Bank Principles. And for us, ESG has to be a clear focus of management. It doesn't have to be perfect on day one, but we will work closely with our client to review their project and suggest ways to, basically tick the boxes on all the ESG issues. And a lot of projects and companies are now seeing the value in attracting different or a range of shareholders in looking at optimization studies on reducing carbon impact, and I think that's a very good thing. And I think that it will attract a different range of shareholders and lenders.
Yeah, Nick, it's also interesting how ESG obviously has risen at a time when COVID, really hit the economy hard. Very different from the global financial crisis when the considerations around the climate were out of the window the moment that the financial sector tanked. But when we look at ESG, it has almost become synonymous with carbon emissions, right? But in places like Africa, many developing countries, there's a much broader consideration here, right? The social license to operate. In South Africa, we have social and labor plans. In many countries in Africa, there is expectations on mining companies to provide critical infrastructure, whether it's
absolutely. I mean, particularly here in Africa, right? The focus on leaving a legacy, not just employment, but leaving a legacy to townships, to communities. Particularly, I think someone mentioned schools, education, health assistance, helping develop power generation, like supporting hydro, for example, here in Africa. I think leaving a legacy is a really critical thing. And, we all know who Mark Bristow is. I've known Mark for a long time, since I lived in Paris and worked for Société Générale. I was coming down in the sort of mid-90s, just before Mark was the anointed one with Randgold. But, I think he is a great standard of creating sustainability within a large mining company and giving back to the community. We all know that he likes to stand on top of the mountain and shout those benefits, but he does it particularly well.
Yeah. So how do you assess as lenders the strength of the social license to operate for a mining company?
Well, it's part of the due diligence, really, a big part of it nowadays, because not having a social license can actually prevent a project from progressing. So that's something we go on site, we talk to the community with our ENS consultant, and that's really something we're trying to understand, make sure that the project is well accepted within its community, not just at the state level, but also close to the mine site.
From our perspective, same thing. During a due diligence phase, we've got a fully fledged EHS team within the IDC that delegates people to go and look at these ESG aspects in the projects that we do. And of course, I want to agree with one of my colleagues. Sometimes it's impossible to have everything ticked off day one. But what we would normally put into our legal agreements is to say, achieve the following within a certain specified period of time, for as long as it's acceptable to us. And of course, we want a social responsibility around the communities where the mines are based.
No, for sure. We have about 10 minutes left, and I have a small enough audience. I don't know whether anybody in the audience would like to pose questions to our panelists. I don't know whether we have a running mic or...
I'll just say one word, China. Your comments on perhaps their lack of ESG credentials and they make it, regardless of any restrictions that perhaps the rest of the world has, their dominance of battery metals alone.
Just very quickly, from my perspective, I do get very anxious when China is the offtake party. Down in Australia, when it comes to our bulks, we're very, very comfortable, of course, with Korea, with Japan, with Taiwan and other Asian countries. But I don't think it's anything new that we're sort of struggling as a nation and banging heads government to government at the moment. So we're okay with a strong Indian company on an offtake, but I don't know. My experience, and I've been about 26, 27 years in resource financing, is that whether the price collapses or something goes wrong, honouring the contract is something that my antenna would vibrate nervously. And it's one of the reasons we're not in graphite. We're not really in rare earths, because we've seen over the decades that if China control the commodity, be very careful about what might happen to pricing.
And that's a big topic in Europe as well. In particular, Europe is very keen on developing a strong battery manufacturing industry, and there's definitely a need as well, probably for some processing capacities somewhere else than China. And given the recent event in Russia as well, I think this is in the mind of people even more than before, that you need to find ways to have some independency, to the extent possible, at least some of.
Yeah, just to add into that, from what we have seen is we've seen a lot of Chinese acquisitions of lithium targets around. We've seen that, as everybody know, the huge majority of the lithium is refined in China, and as well as the cobalt. So China has today a huge demand, or kind of most of the refining of these battery metals are in China, right? So we see in Europe, everybody have seen the pipelines for the gigawatt factories for the EV manufacturers, right? But where are these metals going to come from? They have to buy them refined from China, or they have to create their own supply lines, right? And that's what hopefully will be done.
Thank you. Any other questions? Yeah, Scott, please go ahead.
So we spoke about that in the energy transition that Africa has minerals. Companies we've seen in this all are there doing exploration, development work, and stressing their early ESG credentials and progressing those further as projects go on. From a state government perspective, what can the African governments do to even reinforce that message of we're open for business and we can enable development?
From our perspective in Clarksons as the investment bank, it's give investors predictability and stability, because they know that these are some of the best assets in the world, right? So they are in the first cost quartile. So even how far the prices drop, they still will get their money back and they will be profitable. But when you have less predictability on governance, for instance, it makes the total other risk than if you have a Canadian or an Australian asset, for instance.
But maybe we go back to, sorry, Thabiso, please go ahead.
Yes, I was just going to say, in my opinion, political stability is important in any country. And once you get awarded mineral rights or tenements or whatever that they may be called, I think it's an indication from that government that they're really open for business. And it's left to us, the financiers now, to go in there and develop these projects and implement them.
Fantastic. If we sort of zoom back to the mine itself and to the requirement to show a path towards carbon neutrality, is that really within reach of remote mines in Africa that traditionally have been operating on diesel generators, etc.? Is it possible to run a remote mine in Africa in a way that will at least get towards carbon neutrality? Any perspectives on this?
Up in northern Norway, we have a copper mine. It's called the Nussir. It's a development project, and they are trying to achieve 100% carbon neutrality. So they have, and Norway has 98% hydropower. So it's a good start, and the infrastructure is there. But they see that the machinery for their underground mine from Sandvik and Epiroc, they're twice the cost as normal traditional machinery. But they also see that in size, they're not available. And the batteries are hugely expensive. So it's hard to get it economically viable. And that is as of now. So will it be possible in the future? Possibly. But I think it's a long way to go there.
Indeed, storage is really the key point, right? Yeah, please go ahead.
In Australia, they're talking about leading into the election. There's some conjecture as to whether one or two of the parties, particularly one of the minor parties, will require, for example, coal companies to buy carbon credits, to try and achieve their neutrality or to lower their carbon footprint. So it's just another way of tax. And just to come back to your question, the permitting is a really critical thing. What the government says, what the mines minister say. We've seen, in the last couple of years since the sad passing of the Tanzanian president, massive change in the investability of that country through what the lady president has been basically talking about and guaranteeing, and the relationships that have been established with the major mining companies like the Barricks of this world, and also the permitting that you've seen, the timing of the permitting. And so that makes a huge change for a country like Tanzania, how important a leader of the country and then the cabinet of that country is.
Thanks, Nick. There were maybe a comment question here.
What kind of goals are financiers placing with respect to carbon neutral targets on mines? Particularly, I'm thinking of an off-grid mine where hydropower is not an option and wheeling is not an option. What kind of targets?
At this stage, we don't put specific targets. We look at actually what are the options available and is the company choosing the best option from a carbon standpoint. So to date, there is no specific criteria, but I go back to the comment I made earlier. I think that it might come at some point because banks will have their own targets as well, and we may have to just put the targets back on the companies we finance. But as of today, we're really trying to make an analysis of what are the options available, and we understand companies and projects have to work with what's available, and are they using it in the most possible sustainable way.
I think you have to be realistic, and at the end of the day, lenders, or what certainly drives Taurus, is helping management lower their all-in sustaining costs. We understand the inflationary pressures in the modern world in building and operating a project. So you can't put unrealistic targets as a financier, in my view, on trying to lower that difficult exercise of lowering all-in sustaining costs in the modern world.
Thank you. There was another question here.
A couple of quick questions on product specifics, really. First question on something like lithium, where typically, it's not a standard metallurgy, so you're not like trading coppers. What's the sort of maximum debt level you think you can get on projects where you have a specific offtake? That's the first question. The second one is on products which are unoffered, particularly, is there now a big reluctance to lend to projects?
Yeah. So on the coal point for Société Générale, at least, yeah, we don't finance new coal developments. So that's and that's been the case for a few years. On your first point, the leverage is case by case. Typically, 60-40 is probably the general average we see for projects, sometimes a bit higher, sometimes a bit lower. It's more a question of our assessment of the debt capacity. So we'll run a cash flow analysis with a certain price scenario that's going to probably be a bit more conservative than the management case you're running with. And if the project can sustain, if the cash flow can sustain 60% of debt, we probably would go with 60%. So the offtake is very important to mitigate the liquidity and market risk, but it's a bit different from the price risk. It depends on the overall risk assessment we'll make of the project. But having an identified offtaker for lithium is very important.
Yeah, and just
one or several. Sorry.
Yeah. Start with lithium. It's hard to kind of set, as you say, project to project, leverage to leverage, right? But I think in the target, around 60% leverage is possible. That's what we've seen in the construction financing that we have done in the past. But when it comes to the offtake parties, the importance there is the credit worthiness of those, or the credit risk at these offtake partners, right? You have some Chinese companies that can provide you a floor in the offtake price. But will they honor the floor if the price falls below? That's a very important part. And in the past, unfortunately, in March 2020, without saying any names, things like that have happened. And that will scare the credit investors, which they remember these sort of things. Coming back to coal, as I said earlier today, we did finance a coal mine in December last year, Pembroke Resources, with $95 million senior secured bond. So it is possible, but I would say difficult. A lot of banks and investors are not able to do coal, and some even don't diversify between met coal and thermal coal. So that's kind of where we see it as of now, but it's possible. It is for good projects.
Yeah, so unfortunately we have only 2 minutes. I'd like to wrap up. So what I would say is clearly there is a critical demand for the minerals that Africa has to offer. It includes obviously the battery metal suite and other metals required for the energy transition, but also we see there is still demand for high quality coal, at least in some corners, and there's an argument to be made about whether higher quality coal, has a lower carbon impact and whether it should be funded, etc. We see that the lending and equity markets are open to mining investors in Africa, which is great. Most of the lenders have a pretty nuanced approach to looking at the ESG footprint of and the minerals and the offtake and all this, really looking at it on a project by project basis rather than using sort of blunt instruments to say what's kosher and not in funding mining projects. So I would encourage you all, if you have interest, to speak to any of our panelists or to myself or my colleagues from Marsh about these and other topics. Thank you so much for joining today's session. Thank you.